Hey traders and investors, welcome to another year in the markets. So obviously last year was pretty rough, big bear market that we had to deal with, had to contend with, big market down moves, big bear market rallies, extremely volatile market action. And that's kind of the big question now, is where we're going from here. Are we going to back to the normal of lower inflation, higher growth? Are we going to have a soft landing? Is the Fed going to continue to hike rates even though we're seeing economic slowdown? Those are all the big questions, and really the big question is, what do we buy, what do we sell, what do we hold in this environment? So today I just wanted to run through our model to show you exactly what we look for, and exactly what we think is going to be happening moving forward. We've got a full prediction of what we expect heading into 2023, and it'll give you a lot of clarity as to what you should be or should be looking to hold at this point in time. So let's get started with today's presentation, and it's basically about, is a recession inevitable moving forward into 2023? So as we said, we want to look at our market environment. We want to look at what exactly is going to be driving markets moving forward, and we're going to have a look at our model to give us an understanding of where we're sitting within that. And our model is basically built on the work of Keith McCullough and also the principles of market price. So from a big picture perspective, the prices being experienced in the market at any one time is a function of the interrelationship between growth, inflation, and rates. So once you can understand where growth is going, where inflation is going, and where rates are going, you can start to understand where you're sitting within that market environment. So this looks really complex when it first hits your eyes. So we're going to break it down into components, and by the end of the next 5 minutes, you'll know exactly what we're talking about and exactly where we're sitting within that environment. So it's all about growth versus inflation versus rates, as we said, and really the first or the main two components of that is growth and inflation. So this is just a basic chart or basic diagram indicating growth on the vertical axis, inflation on the horizontal axis. So basically, anytime you move above the horizontal line, you're having positive growth. Anytime you're below it, you're having negative growth. And for inflation, anytime you're to the right of this vertical line, you're having positive inflation or accelerating inflation. And to the left of it, you're having decelerating growth. So what does that mean? It means it gives us basically 4 distinct market environments that we can look for at any one time. You have quad 1, environment 1, where growth is accelerating, but inflation is decelerating. Then you have quad 2, where growth is accelerating, inflation is also accelerating, so they're accelerating together. You have quad 3, where growth is decelerating, inflation is still accelerating, so you have that as quad 3. And then quad 4, where both growth and inflation are decelerating. And you can see how it's just a relationship between growth and inflation at any one time. So what does that mean? Moving forward, we can see it gives us an understanding of the characteristics of each market environment, because you have quad 1 where you have growth higher and inflation lower. What does that mean? It means the economy is chugging along. It means things are going really well. It means we're in a bull market in most instances. And then when you can see, we move to quad 2, growth is higher, but inflation is higher. We're heading into that more reflationary, inflationary environment, but it's still positive. Things are still good, but you may start to see some changes along the way. Quad 3, where growth is lower, but inflation is still higher. That's what we call stagflation. And then quad 4, you have growth is lower, inflation is lower. Generally, that means we're in a recession. It always means we're in a deflation. So you can see how each environment has its own characteristic. And with that characteristic, you're going to start to see what do you want to own in each of these market environments. Because obviously in a bull market, you want to own certain things. And obviously in a recession or deflation, you want to own other things. Then we can start to add interest rates into that picture. So let's say we're moving from a growth higher, inflation lower, quad 1 environment to a full bull market, and we start to see inflation pick up with that growth, and we start to head into that quad 2 growth higher, inflation higher environment. What's going to happen? Well, it's exactly what's been happening, and that's when the Fed is going to start hiking rates, because inflation is getting out of control, growth is really high, so there's room to hike rates. We can start to hike rates into that environment, or that's what the Fed thinks at least. Then when rate hikes start to take hold, growth is going to start to come down as a result of those higher interest rates. Higher interest rates are there to bring the economy down, to cool the economy down. And when the economy cools down, growth comes down, but it doesn't necessarily mean inflation's coming down. As we saw last year, we had lower growth, but higher inflation. It means we're in that stagflationary environment. And that generally is an environment where the Fed wants to keep rates high, but keep them flat, because it knows if it continues to hike rates, then the growth damage is going to be much bigger. And then obviously we start to move from quad 3 to quad 4 into that recessionary environment, and then the Fed will want to start cutting rates, start to stimulate the economy, and then eventually we'll start to head into rates flat, low, and in a low rates or flat rate environment, that's when you have higher growth, lower inflation at first at least. Doesn't mean we're always going to go in a very neat circle from quad 1 to quad 2 to quad 3 to quad 4. These things can change very quickly, like we saw with COVID. With COVID, we saw kind of, I would call it a bull market, low inflation bull market, but it was kind of starting to peter out at an economic point of view. And then we had COVID, we had lockdowns, we went straight into quad 4 really, really quickly. And then straight away, the government started handing out stimulus checks, central banks started cutting rates, lots of stimulus. So we very quickly went from a quad 2 and quad 4 environment into a quad 1 environment. And more than that, we went into a quad 2 environment. So it was a quick quad 1, went into extended quad 2, where we had that long, drawn-out bull market. Everything was steaming along. Every asset you bought was going up. Stock markets only went up. Bitcoin was unstoppable. All of those same narratives that you see in quad 2, that's what we saw in that 2020, 2021 period. And then we started to see towards the end of last year, heading into last year, markets started to peak. We started heading into this growth lower, inflation higher environment, or stagflation. And what's important about this is that we need to understand expectations. Markets work on expectations. They're forward looking. So we want to see from an expectation point of view, where are we headed? Because that's how we can position ourselves. There's no point being in quad 4 and then buying and getting ready for quad 4. You want to get ready for quad 4 when you're in quad 3. You want to get ready for quad 1 when you're in quad 4. So it's forward looking, expectational, and we need to be positioned in that way. And then again, once we've got all of those components in place, we can start to see, well, what assets do we want to own in each of these environments? So when we're in quad 4 expecting quad 1, you want to start buying growth. You want to start buying or keep buying bonds. You want to buy developed markets, developed market FX. You want to buy energy, because if we started to head into a higher growth environment, you're going to into higher demand for things like oil. That means you want to get into energy stocks. You want to be out of the US dollar. You want to start putting those dollars to work. And we start to head into that inflationary environment. Obviously, precious metals do really well in that inflationary environment. Silver starts to rally, gold starts to rally, Bitcoin starts to rally, commodities do well. Your more speculative growth stocks do well. Your Cathy Woods of this world start to emerge. Your cyclicals do well. Your emerging markets do well. Then we start to head into rate hikes. When those rate hikes start to come in, then the expectation is that inflation is going to come down, growth is going to come down. So you want to get out of growth. You want to get out of your commodities, out of energy, out of precious metals, out of risk. You want to start buying value, looking for some good dividend income. You want to start getting into cash. And this kind of really is the hardest part of the market, the very, very difficult turn in the market, because there's so many questions being asked. And that's basically what we were looking at last year. Markets were down, then they were up, then they were down, then they were up. Lots of bear market rallies, so many questions. Is inflation coming down? What's the Fed going to do? Are they going to cut? That's where we get into this environment, and that's where you want to buy lots of value, where you can just kind of stabilize your income with good dividends, knowing that you bought a company with a good balance sheet and with good prospects behind it. And then obviously we move into further on into that environment. So obviously the big question is now, where are we in terms of growth versus inflation versus rates? So let's take a look at growth, expectation for growth more importantly, because once we can get an expectation for growth, we get a clearer understanding of where things head, because growth basically leads inflation, inflation leads interest rates. And that's an important aspect, because if inflation leads interest rates, the Fed is always behind the curve, and they are always behind the curve, which we'll get to later on. So where are we now? Growth. Well, growth, basically changes in growth expectations are often predictable, as the economic catalysts of yesterday take time to work their way through the economy and do so in a cyclical fashion. So what do we mean by that? Well, let's get into another model we use. It's our economic model for the consumer cycle, and this is how it works. So basically, the Fed starts hiking rates. Okay, great. So what does that mean? Well, first of all, what's going to get hit first? The cost of mortgages is going to increase. What's going to happen then? Well, if cost of mortgages is going up, then the housing sector is going to slow, because houses become more expensive to finance, they become more expensive to own, especially if you have a variable mortgage. But the US obviously highly based on fixed mortgages, but it means those people with fixed mortgages that were maybe looking to buy a new house or a second house aren't going to buy one at a higher mortgage. They're going to want to wait. And then you're going to start to see mortgage rates and applications as an indicator. When mortgage applications come down, we know people aren't buying as many homes. When home sales come down, home prices come down, supply and demand aspects come into play, and building permits come down, we know the housing sector is under pressure. When the housing sector is under pressure, what does that mean? It means wholesale inventory levels rise and new orders decline, because people aren't buying as much stuff to fill their new homes. When you buy a new house, then you want to have a new washing machine, a new fridge, a new stove, all those new appliances. You go to wholesalers to get that stuff. But if inventories start to rise, it means wholesalers aren't putting through the inventory. They aren't making as many sales as they would like to. And then we start to look at the indicators of inventories and wholesale orders, or durable goods orders, because that gives us an indication of how much economic activity is happening at that wholesale inventory level. But then again, if wholesalers start to come down, if the inventory levels start to rise, wholesalers aren't going to keep ordering as much new stuff. If their inventory levels are rising, they're going to cut back on their orders, and that's going to start to affect the manufacturing sector. You're going to see manufacturing sentiment fall at first, followed by actual rates of production and manufacturing output. So we start to look at indicators like manufacturing, like factory new orders, like producer price index, like commodity prices, because if commodity prices are coming down, it means the demand for those commodities is not there. And then obviously, if manufacturing comes under pressure, if wholesale inventories is coming under pressure, wholesalers themselves are coming under pressure, it means they're going to start to lay off workers. That's kind of the last pillar to fall. They start laying off workers, employment begins to show weakness and then declines, and we look for that in the initial jobless claims starting to rise. We're looking at average weekly hours starting to drop. We're looking for non-farm payrolls to start to drop, and looking for the unemployment rate to start to climb. Then once that starts to happen, if people aren't getting as much work as they want, they're not getting paid as much as they used to, then employment drops and the consumption of goods and services declines. They don't go to buy as much stuff. ISM services PMIs come down, consumer sentiment starts to come down, retail sales start to drop, core PCE or inflation starts to roll over, and personal income starts to decline. People don't have many jobs. And this starts to kind of become this self-fulfilling cycle, because as employment drops, they stop buying houses, they stop buying stuff to fill those houses, which means factories have less orders, which means they have to lay off more workers, which means those workers don't have enough money to spend in the economy, and they kind of go into this kind of cycle, vicious cycle of a slowing economy, which eventually leads to a full recession. And then we start to look at rate cuts, and then we start to look at the kind of inverse of this cycle. So that's how the cycle works. And once we know where we are in that cycle, we can predict exactly where growth is going moving forward. So let's take a look at some of the indicators of that. First of all, as we said, mortgage rates is the big one. Mortgage year or 30-year mortgage rates have increased year on year faster than any time in history, going all the way back to 1972. So the cost of financing a house has never risen so fast in such a short amount of time, which is obviously going to have an impact on the housing market. Even though there is a delay, these things take time to roll through the market, as we said. But with that delay, you'll start to see the housing market coming under pressure. You're hearing stories of Uber drivers who bought $1 million homes coming under pressure starting to see foreclosures, things along those lines, house prices coming down. And that's exactly what you would expect when mortgages rise so quickly. And again, as we said, if mortgages come down, wholesale inventories should start to come up because people aren't buying as much stuff to fill their houses. And what do we see? We saw initially a big drop because of supply chain issues. And this is kind of the whipsaw problem that the wholesalers have had, because they were seeing, shit, we're running out of inventory, we're struggling to get inventory, we need to get our hands on as much as possible. But at the same time, the housing market was slowing down. And then we've had this massive rebound where they try to get their hands on as much inventory as possible at the worst possible time. And now inventory is through the roof. Inventory is at kind of 20, 30, 40-year highs. They all stocked up, but there's no buyers. So what does that mean? It means manufacturing is going to start come under pressure, because if wholesalers are full of, the shelves are full, they're not going to be ordering new stuff to start to sell to the consumer. So if consumers aren't buying, businesses aren't ordering, new stock from manufacturers is going to be coming down. And that's exactly what we're seeing. Manufacturing new orders year on year, slowly declining towards that negative line, towards that zero line, which is just showing economic growth is slowing down. PPI also coming down really quickly because there's just no demand. Producer price index means you can start to buy things cheaper because the demand isn't there. There's a lot of supply in the market, or maybe not as much supply in the market as there used to be, but there's definitely not much demand in the market, and that's why PPI is rolling over so quickly. And again, as we said, employment is usually the last pin to fall, but it has been resilient. Why is it the last pin to fall? Because employers or companies will keep their employees as long as possible before they need to start cutting employment. Why do they do that? Well, firstly, obviously they want to look after their people in most instances. We live in a good world with good people. You don't want to cut people's jobs too soon or before is absolutely necessary. But it's also really expensive to hire new people and train them up. So you want to hold on to your employees as long as possible until you can't anymore. And that's when you begin to cut your job numbers. And that's what we started to see. The tech sector coming under serious pressure. Amazon just announcing 18,000 workers to be cut from their workforce after announcing further cuts in kind of December heading into the Christmas period, which just shows you how weak the economy is, because Amazon should be pumping over the Christmas period, but we're seeing they're cutting workers. And as we said, businesses will hold on to their staff as long as possible, but they'll start to cut their hours first. So you might start to see hours drop off before actual employment drops off. So there's not enough orders for the factories to be running full time, for these employees to be working their full shifts. So they start to cut the hours of these shifts because they just don't need to be there. That means they can start to pay them less. And you can see that business hours are in the negative already. It means people are working less hours because factories just don't have the demand for factory workers to be working so long. Manufacturing, warehousing, etc., things like that are starting to cut the length of shifts because there's just no demand there. So we're seeing that employment weakness already. And again, when you look at it from a consumer level, retail sales continue to trend lower as the consumer comes under greater pressure. We had this massive rebound in retail sales as pent-up demand from the lockdown periods came into the market, and then kind of reality started to strike, and we started to see this really strong decline back towards negative year-on-year retail sales, back towards negative growth moving forward. Then again, retailers, just to confirm retail pressure, retail sales are down, but credit card debt is up. That doesn't really make sense unless consumers are using credit just to maintain a baseline of where they're at. So it shows here that credit card debt is surging. Australian consumers lean on debt to fund monthly expenses. So they're just using debt to keep or maintain their lifestyle. They're not even upgrading their lifestyle using credit card debt. They're just trying to maintain those monthly expenses. And we're seeing the same thing with personal savings rate. We went into lockdown, personal savings went through the roof because people had nothing to spend their money on. Then the economy opened up, personal savings declined really quickly and started to find a balance in around about February, March of 2021. But then the reality of the situation started to dawn kind of June of 2021. That's where we think the market or the economy peaked. and we started to see personal savings rates being used again, not to upgrade their lifestyle, not to get retail sales pushing higher, but just to maintain the level they were at heading into June of 2021. So we're seeing the consumer under serious pressure. And what does that mean? It means real GDP is on the decline, and we will likely head into a recession heading into March or April of this year. So that's our prediction. March, April, US enters into recession, and it's going to happen at a global level. This isn't just US based, this is at a global level. So if that means growth is heading down, what is inflation going to be doing? Because we need to know, are we in a positive inflation environment or a negative inflation environment? And if we just look very quickly at the core PCE year on year, which is the preferred inflation metric that the Fed uses, you see that we basically topped out in around about February of 2022 from a core PCE level. Energy's been sticky. Energy's been kind of pushing inflation higher, which has been difficult for the global markets to manage. But you can start to see how we've made a higher low, basically, or lower high, excuse me. We started to trend lower, and I believe that trend will continue moving forward. Does that mean things are going to recover? Things are going to get great? I don't think so. So although inflation is declining, it's still sitting above 4%, and the Fed wants it at 2%. So what does that mean? The Fed is going to keep their foot on the gas. They're going to keep monetary policy tight until we see sustained downside in inflation. And by that time, it's too late, to be honest. Let's just take a look at when inflation started to rally. Well, it was basically around about kind of late 2020, early 2021 when it really started to kick off. What does that mean for the Fed? When did they start hiking rates? Because that's the next important factor. Well, they started hiking rates in the beginning of 2022, basically a year too late. They were saying it's going to come back to normal, things aren't going to escalate. The Fed is always behind the curve. That's just basic standard understanding of economics. They're looking at the later aspects of the economic cycle, trying to predict what to do. They should have basically been hiking rates in March of 2021, but they didn't, and they should have been normalizing interest rate policy in June of 2022, maybe September the latest, but they continue to hike into a very weak economy, into a weakening economy, as we keep seeing on these charts. The economy is trending towards weakness, it's trending towards a recession, and what is the Fed doing? They're still hiking rates to get the rates up to around about 5%. That's their target. Terminal level is about 5%. But we're doing that into a very weak and slowing economy. But the Fed continues to look at the wrong metrics. They continue to look, they don't see the trends of economic growth. And that's where we are now. We're heading into slowing growth, slowing inflation, but yet our Fed continues to hike rates. So what does that mean? It means we're heading more than likely from quad 3 of lower growth, higher inflation into growth lower, inflation lower, recession, deflation. But the rates continue to go up, which means we're going to probably head into a deeper recession, deeper deflation. Because again, as I said, monetary policy has kind of an 8 to 12 month lag before things start to occur. So if the Fed continues to hike rates in this environment, it just means we have to go deeper into quad 4 before we can start to recover into quad 1. So summary, our 2023 market prediction: the economy continues to slow as higher rates and debt burdens weigh on consumers and businesses. Rates peak at 5% and remain flat into May, June, despite a glaringly weak economy, destroying all hopes of a soft landing and deepening the coming recession. I believe we'll be in recession by kind of March, April of this year. So we're going to go into recession March, April. The Fed's going to keep rates elevated but flat at around about 5% in May and June. That's already 8 months too late, and we're going to go deeply into a recession as the Fed is doing this all in the name of fighting inflation. So the big question is, what should we own in this environment? That's the question on everyone's lips. Do I buy stocks? Do I buy bonds? Do I buy gold? Do I buy Bitcoin? That's the big question. And the answer, and first and foremost, is you should buy a membership to our investor guidance service, because that's where all of these questions will be answered. We give you actionable investment ideas. We give you detailed video breakdowns of each investment. We give you monthly global macro updates just like this one, so you know exactly where we're sitting in that global macro environment. We also give you monthly portfolio guidance as well as chart breakdowns, so you know exactly what you should be holding in your portfolio, what you should be selling, and where we're sitting within that portfolio level, as well as the charts and what we expect from price action in each of those investments, as well as the dollar, as well as commodities. We also give you access to our Seneca Investor Network. We give you exclusive access to our research team where you can ask your questions, know exactly where you're sitting, what misunderstandings that you have about where we're sitting in the economy. We will help you with that. We will help you get a better understanding of anything that you need to answer. And then obviously, for our new members, we're going to give you that individual portfolio guidance. So you'll come in as a new member, you'll tell us what you own, and we will tell you whether you should continue owning it or whether you should sell it, whether you should get out. We will give you guidance in terms of your portfolio and where you're sitting as a new member, so you can get in line with our foundations and our models. And we're offering 2 months free with annual memberships heading into January, so feel free to look at the link in the description for more details, and that's where you can sign up. So yeah, thanks for your time, really appreciate it. We hope you guys have a great year moving forward. Seems like it's going to be a tough one, but it doesn't have to be tough. You can position yourselves to take advantage of these conditions. There's people and businesses that thrive in these conditions, but these are the businesses and people that understand and don't deny that we are heading into them. They prepare for them, they get ready for them, and they allow them to be there and allow themselves to take advantage of those conditions. And first and foremost, you can do that by joining our service. We can help you with that. Cool guys, thanks so much. Have a great year. Hit like and subscribe if you like this video. We'll be putting out some new stuff, some free stuff to non-members throughout the year, so keep an eye out for that. The best you can do is like and subscribe, so that will give you an indication of when that's coming out. And yeah, like I said, Happy New Year. Hope it's a good one. Much love.